So that's your setup for the day off the back of this earnings report, off the back of the data that we've been waiting for. So let's get to Kevin Green, who joins me now to get across some other numbers. And we're getting some existing home sales print. Talk us through what you're seeing as far as that one, KG, this morning.
Yeah, for existing home sales, we actually saw that number coming in at 4.1 million for the month of October. The street was looking for 4.08 million, so pretty much in line with the street's expectations. We did see a little bit of a revision down from the last month as well, coming in at 4.05 million. Last month they had 4.06 million. So for the most part, existing home sales are holding up for now. We obviously have seen rates move to the downside here on a general basis over the last couple of months or so, but we are still not back to the levels that we saw pre-2023 or so. So for the most part, still muted. We are seeing inventory hitting into the market. Maybe some buyers are kind of stepping off the sidelines and getting into this market here. But as inventory does expand, we are expecting prices to actually come down, and that could also activate buyers in this market as well here. So very interesting print. Obviously, we had a lot of economic data, not only this morning, but with the Nvidia news last night. We are reaching, for the most part, highs of the session at the moment here. It looks like the market does appreciate it.
Yeah, absolutely. Another thing, of course, they do appreciate is the upside surprise we've got on the delayed September jobs report. Talk us through the numbers as far as some of the metrics that stand out to you, because the jobless rate did actually tick up, but it really was the 119,000, which came in much better than the around 50,000 that the market was expecting. That is the big focus today.
Yeah, we did see a better than expected print when it comes to the month of September. I'm not sure the market's so optimistic about the number that's in September. Obviously, it did exceed the street's expectations at 119,000 jobs. The street was looking for around 51 to 52,000 jobs to be added for that month here. But I think the big bright spot, which is why yields actually started to move a little bit lower, is the August print actually was revised lower. It went from a positive print down to a negative 4,000 for August. And we did see a revision to the downside for the July print as well. What does that really mean? These aggressive revisions in previous months kind of gives us a better picture as to the health of the labor market. And right now, that revision doesn't look that great. And so you might start seeing some members of the Fed, especially Barr, who is speaking right now, maybe a little bit more concerned about the labor market because of these aggressive revisions to the downside. Now, unemployment rate did actually increase to the upside to 4.4%. Previously, it was at 4.3%. And average hourly earnings on a month-over-month basis came in at 0.2%. That's actually a really decent inflationary gauge here. You're starting to see that decelerate, and that could also help out CPI as well as PCE here. So I think this is actually kind of a Goldilocks print. Once again, not so much concerned about the outsized jobs that were reported in September, but the revisions that we saw in July and August, I think is really what's driving a lot of the enthusiasm that the Fed could still cut in December.
So certainly looking at some of the revisions as well, that's important to keep in mind, particularly as you mentioned, we're seeing in the bond yields this morning. Let's talk about what we're seeing in stocks here off the back of course, and now we've got Nvidia out of the way. Now we've got some of the September jobs out of the way. We're seeing the VIX backing off. We're seeing equities rallying today. What is that telling you? What are you seeing as far as the charts and the technicals are concerned?
Yeah, so you are seeing a crush in volatility for now. The VIX is sitting at around 19.6. Keep your eye out on the VIX if you're looking at it from an intraday standpoint. We are starting to see it actually inch up a tad bit. We are hitting highs of the session right now, and we're getting very close to that 20-day moving average for the S&P 500. We're only about maybe 20 points, 21 points away from that as of right now here. So at the end of the day, we've had an outsized move to the upside, up 1.8% on the S&P 500. Almost every sector is in the green. It was, well, last time that I checked, we have 80% of the stocks so far in the green right now. But you are starting to see maybe a little bit of a pullback in some of these metrics just on an intraday basis. This is a good day. For the bulls, you want to be able to hold these levels, stay positive, at least close above that 50-day moving average, and not see an aggressive reversal like we saw yesterday, which was, once again, a part of a low liquidity type of market. So we got a lot of events out of the way. We'll focus more on policy moving forward. But at the end of the day, we still have to recapture that 20-day. I think that's going to be a very key area of resistance for the market, and that could also be a pretty decent point for short sellers to try to come in and knock the market back down. So good overall. Numbers were obviously fantastic, but this market still has to prove itself in more ways than one.
Okay, let's switch gears to the currency market, international markets as well, as far as what we're seeing in dollar yen this morning. We did see the yen actually weakening to the lowest level in around 10 months yesterday. It picked up a bit overnight, no doubt pressured by not just what you're saying with respect to what the Fed is actually going to do, but also on the other end of things, what they're talking about as far as a more sort of expansionary fiscal policy over in Japan. There seems to be a little bit of pressure on the Japanese currency off the back of that. I'm seeing those bond yields, the JGBs, spiking this week. We've got the 20-year at levels not seen since '99. So talk us through the importance of this and why US investors should be paying attention to it.
Yeah, I mean, look, we're having a great day, but I am going to bring this kind of up here. We are actually seeing 10-year Japanese government bonds blow out to the upside here. Actually, they're at levels that we have not seen since 2008. The country is looking like they're going to approve a stimulus package with the equivalent of around $135 billion. Now, this is trying to combat inflation in some respects, maybe also to restart some of the housing market weakness that we've seen in certain pockets within Japan here. And we know that they just had an election, a new leadership actually taking the helm here. So what you are seeing is not only the yields in the Japanese bonds actually moving to the upside, but you are also seeing the yen weaken here. And the last time that we saw the yen weaken towards these levels was back actually in January of this year. What happened around that time? It was that big concern that the yen could actually break through that 160-ish area if you're looking at the US dollar yen pair here. And that actually caused a little bit of a concern when it came to heightened volatility, as well as the concern that maybe Japan actually does liquidate some treasuries in order to raise cash in order to deploy within their markets here. Is that a number one theme for today? It's not, but it's something to keep on the radar here. The yield market across the globe is still slightly elevated and moving a little bit higher here, and this could be something that does come back into the front, the forefront here if this narrative around the debt market, sovereign credit, AI credit, if you will, continues to linger around, and we still see credit default swaps at an elevated level compared to historical averages.
Yeah, I mean, this is, of course, a sort of a fixed income story globally, isn't it, KG? I mean, I heard Ray Dalio also talking about it this morning. I mean, this is just showing us, as far as the long end of a lot of these countries with their yields, the growing discomfort over the amount of borrowing that's needed to really fund a lot of their stimulus plans. So we'll have to keep an eye on that one. But as you mentioned, $112 billion stimulus package coming out of Japan that's being reported right now. Let's switch gears to the commodities space. I'm seeing that oil is ticking up higher. You and I were talking about the US consultations to potentially bring an end to this war. It looks like the Kremlin has come out and denied that now. I'm also looking across gold as well, catching a bid. I actually just noticed this morning the Shanghai Exchange issued an alert to investors on risks of gold trading. Now, of course, this is something that sometimes the authorities do over in China when they're worried about some of the volatility there. What are you seeing as far as the commodity space?
Yeah, in Shanghai, I believe it was about a month ago, they did the same with copper. When we started seeing that aggressive move higher, they started putting limits when it comes to copper size as well as positioning. You could also see the same when it comes to lithium. Lithium over in China is ripping to the upside if you're looking at that commodity as well. There is also a physical demand story that is there. If we're looking at the oil markets right now, you're seeing a nice little bump to the upside, up about 0.7%. Yes, Russia is kind of pushing back on this Russia-Ukraine peace deal that the U.S. has kind of offered here and quietly signed off on. And if you're looking at maybe some of the demands for Russia and what they would like to see for Ukraine, they've denied them in the past. They're probably going to deny them in the future, giving up a significant amount of territory, not able to have any type of support staff when it comes to countries in their country as well. A lot of things there. So you are seeing oil kind of re-rate a little bit higher, maybe a little bit of optimism there also when you're looking at the overall equity market as a whole here. I'm keeping my eye out on silver. I think that's the biggest risk gauge that you have in this market right now. Silver, industrial metal, obviously needed for a lot of electronics, needed for data center build-outs. It's short deficit when you're looking at supply out there. Silver, I think, is going to be your telltale sign. If it can break out higher here, I think equity markets follow it.
Yeah, I mean, silver managing to hold that 50, which is certainly an interesting move here, particularly as a lot of analysts out there have been talking about this sort of broad commodities bull market, particularly moving into 2026. That is something certainly to watch as far as the precious metals. KG, always appreciate it. Thanks for getting us across these key stories this morning.